Flow of fund, that means change of the position of fund from one place to another. Because without the flow of fund, the company will not function at all. Fund flow statement is the statement which shows where all this fund was used, how all this fund was arranged, and everything about the chain, the flow of fund. Okay, so the fund flow statement is a financial document that track a company's fund over time, showing the source and use of fund. That is the main two things a fund flow statement will show. It will show the sources of fund. That means from where all the fund has arrived our business, and also it will show the uses of fund, which means where all the funds that arrived from different destination have been used in the business. Basically, fund, when we say fund flow statement, means working capital. So we will see what happened to the change in what are the changes that happen in working capital over 2 days, and see what all other thing contributed to the change of fund available for the business. I know it will sound a little bit confused. Let's straight away go to the important aspects of fund flow statement. As we have said, the main components of fund flow statement are sources of fund and uses of fund, which means from where all the fund has arrived to the business. This can include issuing of shares, taking of loan, or selling of a long-term asset. All these things bring fund into the business. The basic idea we should have is whenever a transaction, whenever a change happened in the business, just think whether that change or whether that transaction will bring money into the business or will it take out of the business. In other words, whether it has inflow of cash or outflow of cash. That basic thing should you have in your mind while you are preparing a fund flow statement. Let's see it. See, when we issue shares, when we issue shares of our company, just think whether the company will have a inflow of fund or outflow of fund. Definitely, we will receive fund from different investors, isn't it? So it is a source of fund. It is one of the sources of fund for the business. Similarly, when we take loan, whether cash will flow into the business or cash will flow out of the business. Definitely, when we take loan, we will receive a huge amount, isn't it? So it is a cash inflow, which means it is a source of fund. It is one of the sources of fund. And when we sell asset, just think when we sell assets, what happened? Whether the cash come into the business or whether cash go out of the business, yes, it is very clear that cash come into the business. We are losing one of our asset. Instead of that, some of the buyer of the asset, what they will give, they will give cash to us, so we will receive cash. So it is source of fund. Similarly, if when a transaction happen or when a change happen in the business, if it contribute to the cash outflow, then what will be called? We call it as uses of fund or application of fund. For example, here it is given when we purchase a long-term asset. When we purchase asset, we are receiving something asset is correct, but what happened to the fund available for the business? We are losing our fund, isn't it? We are paying our amount to get that asset. So it is a use of fund or it is an application of fund. Similarly, just think we repaid a huge loan. We have to spend a huge amount to repay our loan. When we repay a huge amount, what will happen? We will lose money. Of course, we are losing one of our liability. We are getting relief from that. At the same time, we are losing the liquid cash, the money, the funds available for the business. So when we repay a huge amount of loan, it is an application of fund. I think it is clear to you. Similarly, when we distribute dividend, what happened? Whether the cash flow into the business or whether cash flow out of the business. Just think it is very clear when we give dividend to our investors, the cash will flow out of the business. So these are the main two components of cash flow statement. A cash flow statement is otherwise known as a statement of sources and application of fund. See, we use fund flow statement to assess the financial health of the business. We just look up on the long-term solvency of the business. It will track the capital structures change, what all change happened to the capital structure. It helps in financial planning for the business. Okay, there are many such importance for that. This is the format of a fund flow statement. It is otherwise as the statement showing sources and application of fund. Since the headings of this statement is as sources and application of fund, it is otherwise known as statement showing say sources and application of fund. Here we will write application of fund. Here we will write sources of fund. Remember, there is no such defined format for fund flow statement. Still, we follow something to bring unity. Here we will write things that causes cash outflow. Just remember, this is just a format. It doesn't mean only these things will come. If increase in a non-current asset happen, what will it cause? Increase in non-current asset means we have brought something, we have bought something into our business. So we will lose our fund. It is an application of fund. When there is decrease in non-current liability, when there is a decrease in long-term liability, what does it means? It means we are paying our loan, we are paying our liability, isn't it? So there also we will lose our money. So just have that idea in mind, whether we will gain money through a change or whether we will lose money through a change. When we gain money, it is stated under the sources of fund. When we lose money, it is stated as one of the applications of fund. We can just dive into one of this question. Yeah, here is it. It was a previous question and it is stated that balance sheet of X1 is limited at the end of 2016 and 2070 are as follows. See, the balance sheet is given, liability side is here, asset side is here, liabilities of 2016 is given here, liabilities of 2070, assets of 2060, assets of 2070 is here. Now we are asked to, you are required to, okay, you are required to prepare a statement showing changes in working capital and fund flow statement. Remember, if the question was just to prepare fund flow statement also, we should have to prepare a statement showing changes in working capital. This is because the change we find through the statement showing changes in working capital will also become a part of our fund flow statement. I will show you how it comes. So, as per the question, we are going to prepare a statement showing changes in working capital first. Here is the format for you. A statement showing changes in working capital. It will have particulars column. First year's column, that is 2060 for the question. Second year's column, that is 2070 for the question. And here is the change column. We will just note down the changes happened between 2016 and 72. Current assets and current liabilities alone. Okay. Now we can see, first of all, from the liabilities, from the very first thing you have to do is take the balance sheet, find out the current assets and current liabilities. Here I am taking liabilities first. Accounts payable being something that have to be paid as soon as possible. It is a current asset, sorry, current liability. Notes payable, it is what? It has the same meaning as accounts payable. So just leave it, even though it is what? A current liability. Now, other current liabilities, we needn't have the name itself say it is current liability. So these three things fall under current liability. Remember, what is current liability? Liabilities that have to be repaid as soon as possible. Now look at the fourth one. It is 6% bond. Bond is often repaid periodically. It will take more than 1 year. So it doesn't fall under the head of current liability. Retained earnings remains in the business for a long time. Mortgage loans remains in the business for a long time. What is mortgage loan? Loan taken with pledging some physical objects like land, some unmovable objects. Okay, there are some immovable objects like land, building. We can pledge it and take a loan. It is known as mortgage loan. Now, share of the business. Okay, it will also remain in the business for a long time. So it is bloody clear that everything below other current liabilities are not current liabilities that have to be paid over 1 year. Okay, so they are not current liabilities. Now we know only the first three things are current liabilities. So we are going to take it down to the format. Okay, first it was current asset, leave it. The question it was current liabilities. We can just write these things, write the amounts below. Okay, yeah, I have just picked out just current liabilities from the total list of liabilities in the balance sheet. Remember, what is current liability? Liabilities that have to be soon repaid. You should have an idea about that. You should be able to recognize that unless we can do nothing here. Now we can move on to the assets and see which all are the current assets. Remember, like current liabilities, current assets are assets that are used up early, that will not remain in the business for a long time, that gets used up very early. Cash is the most basic current asset. Everybody know that. What is marketable security? Securities that can be easily marketed. That means it will be sold within 1 year. It will be sold soon. It has high liquidity. So marketable security is a part of current asset. Inventory, we take inventory to sell it as soon as possible. See, that logic is involved. Okay. Now you know very well inventory being a part of something that is sold. It will be sold very soon. It will be replaced with another inventory soon. So it is a part of current assets. Similarly, we have receivables. Receivable, the name itself say something we need to receive as soon as possible, that we expect to be repaid as soon as possible. Such things are also part of current assets. I am repeating, the ability of you to recognize current assets and current liabilities is very important here. So make sure you are okay with the concept of current asset and current liability. See, fixed asset, the name itself say what is it? It remain in the business for a long time. So just ignore it. It doesn't become part of what? Our current assets. So it is not a part of current asset. Accumulate depreciation. It is accumulated. See, to explain that, I should tell more. Just leave it. It is not part of current uh, assets. So we have found our current assets. Here are our current assets. So similarly, like we have written current liabilities, I'm going to list down the current assets here. I'm going to write the amount of current assets here. After that, we can see the change in current asset and we can find the final important answer, that is working capital. Okay, here we go. Okay, now we have our current assets and current liabilities listed here. Now we can see what change happened to each thing in each year. Here we have cash. Cash was in 2016 it was 10,000. In 2017 we have just 5,000 remaining with us. So we know the change is decrease. So below the column decrease we are writing the change, that is difference between 10,000 and 5,000. 5,000. Marketable securities, we had 10,000 rupees worth marketable securities in 2016. When it came to 2017, there are no marketable securities remaining. That means what? We have sold every marketable securities that we held with us, isn't it? So that means what? There was a decrease. There was a decrease of 100% occupation. That means we have lost everything. So the decrease is 10,000 minus 0, that is 10,000 itself. Inventory, it was 70,000 in 2016. It has increased to 1,05,000 in 2017. So what is the increase? We can take the difference, that is 1,05,000 minus 70,000, that will give us 35,000. Use cross check it in calculator. Now, receivables was just 30,000 in 2016. It is now 40,000 in 2017. Similarly, what is the increase in receivables? It is 10,000 rupees increase. Yeah, 10,000 rupees. Okay. Now, remember, we are not going to take the total of increase and decrease here. There is an approach. There is an approach of preparing statement showing changes in working capital by taking this total and taking the difference and all. I'm not going for that because that is little bit confusing. I don't want to confuse you. Just now, remember, we just found the current assets and current liabilities from the balance sheet. We just listed them down. We just saw the change between them, whether it increased or decreased. If increase or decrease, what was the increase of decrease? After that, just take the total of current assets, just take the total of current liabilities and find the difference here. Now we can take the total of current assets, it is 10,000 plus 10,000, 20,000. 70,000 plus 30,000, 1 lakh. So the total is 1,20,000. I just write in here. You can cross check it with the calculator. Now in 2070, what was the total of current asset? 5,000 plus 1 lakh 5,000, 1 lakh 10,000 plus 40,000. It is 1,50,000. Yeah, 1,50,000. So in 2016, the total of current asset was 1,20,000. In 2070, the total of current asset was 1,50,000. Similarly, we are going to see the change in current liabilities, and finally, we will take the total of current liabilities in both years. Okay, let's see. Accounts payable was 15,000 in 2016 and 20,000 in 2017. Okay, so let's see the change. It means if the current accounts payable has increased, isn't it? There was an increase in accounts payable. It was just 50,000, it become 20,000. So in the increase, you will write the difference 20,000 minus 50,000. That is what? That is 5,000. Notes payable was 25,000 in 2016 and 10,000 in 2017. That means there happened a decrease, isn't it? It was 25,000 in 2016. It decreased to 10,000 in 2017. So here we are going to write the decrease, that is 50,000. Similarly, other current liabilities was 10,000 in 2016. It has increased to 15,000 in 2017. So under the increase column, we will write 5,000. That means the change alone. Don't write the entire amount, just write the change amount. So we have considered all current liabilities. We have taken the changes. Now we are going to take the total of current liabilities. See, in the year 2016, the current liabilities amounted to 40,000 plus 10,000, 50,000. In the year 2070, okay, in the year 2070, the current liabilities amount to 20,000 plus 10,000, 30,000 plus 15,000, 45,000. So we have got the total of current assets. We have got the total of current liabilities. Yeah. So how to find working capital? See, we have taken the total of current assets as total A. We have taken the total of current liabilities as total B. So working capital can be written as A minus B. Simple. So we will take this total and deduct it from this. We will take this and deduct this from the total. That is A minus B approach. It is 1,20,000 rupees for current asset in 2060 and 2060 the current liabilities is 1,20,000 50,000 rupees. So the working capital is 1,20,000 minus 50,000, that is 70,000. I hope you got that correct. The formula, the way to find working capital is difference between the total of current assets and current liabilities. We have the total of current asset in 2016 as 1,20,000. The total of current liabilities is 50,000. The difference is 70,000. Similarly, for this year, it is 1,05,000. Can cross check it with your calculators. Yeah. Now, once again, we are going to see the change. What change happened to both of these items? Has the working capital increased? Yeah, it is very clear. In 2016, the working capital was just 17,000. What happened in 2017? In 2017, it increased to 1,05,000. That means there happened an increase of 35,000 rupees. Okay, by finding this, what will happen? We have completed our statement showing changes in working capital. We just show what change happened to working capital and what all caused that change, isn't it? We have seen the increase and decrease in each current assets and current liability. So, as the name says, we have seen the change in working capital, and the statement is showing the complete reason for the change in the working capital. Now we are moving to the next and the most important part, preparation of a fund flow statement. I had told you earlier, fund flow statement shows the change in fund. That means we are going to see whether each change caused an increase, cash inflow or cash outflow. We are going to assess whether each change happened in the balance sheet within 2 years, caused an increase in fund available for the business or decrease in fund available for the business. You should have that logic with you, then everything is okay. Remember one thing, we are not going to consider current assets and current liabilities again. We have already considered it. Just leave it. We are just not going to take this into consideration. We are going to see the non-current liabilities first. Yeah, we have 6% bond. The first thing you have to see is whether it increased or decreased from 80,000 to 1,10,000. It is very clear there happened an increase of 30,000 rupees. Okay, so we have found that there happened an increase. Now the question is, now the logical reasoning is whether this caused a cash inflow to the business or whether it caused a cash outflow to the business. Just remember, oh, I'm really sorry, I'm really sorry. Uh, okay, 6 percentage bond was 0 in 2060 and in 2070 it is 20,000. Okay, I just took another row. I'm really sorry. Okay, remember there happened an increase of 20,000. There was nothing called bond in 2016. In 2060 we have a bond of 20,000 rupees. Okay, now the question is whether this goes a cash inflow or a cash outflow. Since it is something like lending, it's something like taking a loan. When we take a new loan, just think, will it bring cash into the business or will the business lose cash? Of course, when we take a new loan, we will get cash. There happens a cash inflow into the business. Similarly, since we have issued some bond, the cash will flow into the business. Okay, hope the concept is clear. So this 20,000 rupees have flown into the business. We have received this money in the year 2017. So from the view of a fund flow statement, what is it? It is a source of fund. Similarly, when we move on to the next item, it is given what? It is given profit and loss account. Remember, profit and loss account balances are taken as fund from operation. We can see the difference. Okay, it has increased. I mean, yeah, the amount, the profit in the year 2060 was 80,000. It has increased to 1,10,000. So there is a difference of 30,000. This difference is termed as fund from operation. It has a term. It is, of course, a source of fund. We have received more profit means it is a source. It is an income for the business, no doubt. It has another name, fund from operation. What if it was a difference? It was a loss. If it was on like 10,000 in 2016, and if it was 18,000 in 2070, it will not be called as fund from operation. It will be taken as fund used in operation. I'm not going such deep. We just need to learn the basics, so I'm not taking it deeply, but understand it is called fund from operation, and that difference is taken as what? A source of fund. Now, mortgage, just remember it is another loan. Mortgage was 0 in 2016. It was 10,000 in 2017. That means, once again, remember whether the cash has flown into the business or whether the cash has flown out of the business. No doubt, cash has flown into the business. We have received money when we take a loan, when we pledge something to take a loan. Of course, we will receive money. So it is a source of fund. Similarly, what is the next item? Shares, no change. No change means no flow. No flow means we needn't take such things to the fund flow statement. Okay. Okay. Now we have assets. We have checked the changes in liability. Remember, we will not take current liabilities and current asset. I am just keeping this much current asset. Current asset. Yeah. We have just two current liabilities. One is fixed asset, other is accumulated depreciation. Fixed asset, what change happened? It was 1 lakh in 2016, it is 1 2 in 2017, it is 1 lakh 40,000. Of course, it increased. When the fixed asset increase, remember, just think, will cash flow into the business or will cash flow out of the business? Just think, you have purchased something so that Your fixed assets have turned from 1 lakh to 1 lakh 40. Now think, now imagine, will you lose money or will you gain money? Of course, whenever we make a purchase, it is clear that we will lose money. It is a cash outflow, so it is use of fund. Similarly, we have accumulated depreciation. We Cumulative depreciation have some special treatment in fund flow statement. Just forget, we are not going into deeper. We just need to learn the basics. We can see what we have written. Here it is 40,000 negative balance in 2016. It was 55,000 negative balance in 2017. Try solving this with a calculator. You can find that the change happened here is an increase of 50,000. Okay, just think, a liability has increased 50,000. Of course, when there is increase in a liability, that means we are getting more fund. Okay, it has a separate treatment in fund flow statement, but remember, for your easiness, I'm telling you accumulated depreciation. Just see the change, what happened there. There happened increase of 50,000. Since it is a fixed asset that is increasing, we can take it as a source of fund. Okay, by increase of accumulated depreciation, it is clear that the cash will flow into the business. I'm not explaining it because to explain it, I have to go deeper. Just forget it. We are just seeing whether the liability has increased or decreased. Since the liability has increased, we can easily assume that fund has flown into the business. Now we have seen where all the fund has flown into the business, where has all the fund has flown out of the business. I'm just going to mark it once again. Where from here 6 percentage point increase, so it is a fund flow. Okay, I needn't mark, I just will directly put it into the format. See, here we have the fund flow statement. We can just put down the application of fund here. We can just put down the sources of fund here. We can take the total. So here we have posted everything. See, I've just written what we have told in words. First thing, we have just forget about the current liabilities. Moving on to the very first non-current liability, it was what? Bonds. 6 percentage bond has an increase, isn't it? Okay. 6 percentage bond had an increase. We have written it here. Increase in bond. It is a source of fund. Then what was the next item? Increase in profit. I had told you it has a name, fund from operation. It is taken as a source of fund. Fund from operation, the difference was 30,000. Remember, we are just taking the difference. We need to know the change alone. Mortgage loan was 0 and it was 10,000 in 2017. So we will take increase in mortgage loan as 10,000 as source of fund. Remember, when we take mortgage, we are receiving money. So we took it as source of fund. Similarly, okay, after that shares, no changes there. We are just not looking into the current assets. Moving on to the very first current as non-current asset, it is fixed asset. It was 1 lakh in 2016, it was 1 lakh 40,000 in 2070. That means there happened an increase of 40,000. Remember, when fixed asset increase, it is application because it means we have purchased something, we have used the fund available for the business. So it is taken as 40,000. After taking fixed asset, we have accumulated depreciation. It has increased 15,000 since there happened an increase. We will take it as a source of fund. Remember, I had told you accumulated depreciation have special treatment because depreciation being a non-cash item, even though it is written here, since it have a negative balance, it is taken with the form of a liability. So when depreciation increases, just have this in your mind. When depreciation increases, it is taken as a source of fund. Okay, there is a huge story behind that. I am not going to go such deep. Okay, we have taken here. Similarly, working capital, the increase in working capital, just think, is it an application or source of fund? Very clear, it is application of fund. We have more working capital means we have more money spent for our day-to-day activities. That is the concept behind that. Okay. So when there happens an increase in working capital, we will take it as application of fund. When we take a source of working capital, sorry, when there is a decrease in working capital, we will take it as a source of fund. Now we have taken it as an application of fund because why? There happened an increase of working capital. So by when this is the last item we have to take. Okay. By then we have taken all changes happened in the working cap. I mean the balance sheet. We have taken the changes happen in working capital. So we have taken the every change within the 2 years, 2016 and 2017. If what we have done till this is correct, the total of application of fund will be equal to the total of sources of fund as always. See, we have 40,000 plus 35,000, 75,000 here. Here we have 20,000 plus 30,000, 50,000 plus 10,000, 60,000 plus 50,000. So 15,000, 75,000 as the total here. So I hope the concept is clear for you. You should have the ability to recognize which all are current assets, which all are non-current assets, which are current liabilities, which all are not current liabilities. From that, you can prepare statements showing changes in working capital. Remember, the change in working capital is important. After that, we will move on to the non-current liabilities and non-current assets. From there, we will see whether it increase or decrease. And the main concept is whether that increase or decrease caused cash inflow into the business or cash outflow into the business. Hope this was clear to you. If it is not clear, if you want more explanation, please let me know. Okay. By then, thank you all.